Well, good afternoon, everybody. Welcome to Bull Sessions, our August 31st edition of Bull Sessions. My name is Mark Robertson. I'm joined here by Ken Kavula and our special guest from Florida, hopefully staying safe from the weather, Kim Butcher. How you doing, guys?
Things are going great. It's a beautiful day up here today, mid 70s, just a very slight breeze. We almost lost our entire patio umbrella and table a couple nights ago.
Oh, no.
Yeah, it was, the table was on two legs and the umbrella was just moving wildly around. Natalie saw it, ran out and grabbed everything, but
So did my little storm from down south affect you like that then?
no, this was just we've had a strange weather pattern of thunderstorms just marching across the state. It felt like Florida, Kim, where you get a thunderstorm every 5 or 6 hours, and that's what we had marching across the state for 5 or 6 days. Only they were accompanied by pretty high winds and, in a couple of cases, some pretty large hail. So,
well, let's hope the weather behaves itself as it all passes through the Florida zone down there. And again, thoughts and prayers for Louisiana and Mississippi and any places that are affected by the most recent turbulence. And disclaimer up front.
Maybe we have to make our tinfoil hats out of something a little bit more sturdy, Mark. What do you think?
A little more protective, huh?
A little bit more protective, right? I see you have a colander on your head, right?
I do. The colander is from 4 years ago. That was our roundtable from 4 years ago, where it happened at the same time as a solar eclipse.
Oh,
and there was an article about looking at the eclipse through a colander, and somehow that weaved its way into our theme for the roundtable 4 years ago. So I wish I could say I remember what was going on with our tinfoil hats, but maybe it's best left alone. Just a warning in advance for everybody. We are having some construction done at our house, a little remodeling project, so you may hear a little bit of noise. If it gets excessive, I'll switch over to Ken and shut up for a few minutes. But today's session is our session before the roundtable, so we do kind of truncate these a little bit. So let's go ahead and get underway. We do want to talk about what we looked at 4 years ago at the roundtable and take a quick look at some indicators. Just kind of kick a few things around, but let's go ahead and get underway. All right. Again, the reminder that no investment recommendation is intended. This is about education with emphasis on the demonstration part of illustrating the core philosophies, methods, techniques, basically the belief system of the modern investment club movement, as interpreted by us at Manifest Investing and as championed by the National Association of Investors, also known as Better Investing. You'll hear opinions. We do try to disclose if we own a particular company that is under discussion. Now, tonight's roundtable, again, is at 8:30 Eastern Time. It's on the last Tuesday of every month. If you'd like to be added to the reminder list about that, you can send an email to nkavula1@comcast.net. And if you have any thoughts, suggestions for future topics, that sort of thing, send an email to markr@manifestinvesting.com, and we'll do our best to incorporate it. We got a couple this morning that we'll be adding to the bullpen queue. Any other thoughts or comments?
no, our queue keeps growing here. We have a lot of things to deal with. I like a couple of things we're doing today, so let's get started on it.
Okay. So again, we've been doing this a little bit over a year. We try to grab a topic or two and just kind of kick them around a bit. Sometimes there will be some debate, and sometimes it will resemble those moments when Ken and I are on the road together, and he pulls over, and we get out and we roll around the rest area and
Roll around? Does that mean you just ate lunch too?
a little bit of turbulence on the road, yeah. But there's a number of topics there that I think will be most interesting as we go forward here in a few weeks. We are going to tackle inflation here shortly for those of you that are waiting for that. But for today, again, keeping it short, we're going to just look at the roundtable from 4 years ago, talk about some screening results, And actually, I shifted gears a little bit and ended up focusing in on one predictor. We may come back to that topic in a future week, just the total arsenal of predictors and how they've done over the years. This is a public service announcement now because we have put the scorecards out there on the groundhog. This is just simply to, perhaps for those that are not more closely affiliated with us, just a reminder of the top 38. These are the ones that are beating the Wilshire 5000 amongst our 144 participants. That is the current real-time numbers. We see that Nick is up there with his harem of ladies up at the top of the standings. Ken continues to celebrate the fact that he's involved with a number of those clubs that are bolded up at the top, including the Manifest Investing Roundtable, which is something Kim and I like to lean on because we're part of that. Our individual entries are not so strong, but some pretty good stuff there, Ken. You're holding in there.
I want that chart that you show every now and then with our cumulative percentage. I'd like to raise that up a point or two. So I worked real hard on this particular. I must have spent 14 minutes on this particular entry.
All right. Well, our individual entries are doing a little bit better. We still don't have enough people beating the market. And Kathy Wood continues to advance up the chart. She's up to 133rd now. And again, we respect Kathy and enjoy her work. So that's not meant as a slam. It's actually more meant as a reminder that humility can be an important part of what we experience as investing. And my entry this year is about neck deep in humility. As I think I'm in triple digits now in the standings. You have to scroll quite a ways down the scoreboard. Speaking of the scoreboard, it is here. You can get to it at that public scoreboard, and you can drill into any of the portfolios if you're curious as to what Ken or any of Ken's clubs have invested in this year's Groundhog Stock Picking Challenge. You can take a look there. And a lot of familiar names again at the top of that chart. And we will continue updating the individual entries and keep that as current as we can.
Well, tell us a little bit more about Jellicle Cat, Mark. Where's that entry coming from?
Where is she at on the list? Is she?
Well, she's in the top 38, or he 33rd.
Yeah, that's actually a pseudonym to protect the identity of somebody. We do allow pen name entries, and Jellicle Cat has participated in a number of annual contests and has done fairly well. We actually had a participant a few years ago that had to assume. We generally like to stick to real names. I mean, that's just part of the community spirit here at Manifest Investing, and for that matter, at Better Investing. We don't hesitate to use real names and absorb our doses of humility. But we did actually have a participant that was involved in running for office and had to switch that individual's name to kind of withhold the identity for a while, just to honor that need. All right.
There's a story there. I hope maybe after 10, 15 years you can tell us.
At some point we can probably tell that story, yeah. Okay. So let's go ahead and talk a little bit about 4 years ago. 4 years ago, Kim and Ken, Hugh and I, came together in the shadow of a total eclipse, put on the headgear, and picked some stocks. And they didn't do great, but they didn't do terrible. You can see the entries down there at the bottom. They were chosen on August 22nd, 2017. And FleetCor was selected by Ken and seconded by the audience. And that one is still in the current active tracking portfolio today. You can see that it's actually generated a return of approximately 16%. That is annualized, versus a market which is slightly higher, but that's still, I would call that an acceptable result. You feel okay with that, Ken?
I feel pretty good about that one. The Model Club in Bridgeport is considering adding to its FleetCor holdings. We still like the stock quite a bit.
Yeah, it continues to pop up as, that's a key area. Kim is very attentive to to the monetary side of things when it comes to the PayPals and currency type companies of the world. So I'm sure that's not too far off her radar screen either.
FleetCor had a pretty bad last 18 months or so. Things were kind of rough for it, but it's got its stuff all back together again. The graph is moving back towards trend, and that's all you can ask of a company to keep growing at some kind of a nice steady rate.
Yeah, and we'll take a closer look at that in a minute. The third selection there was by Hugh, and he basically was in the mode of liking companies that were loathed at the time, sullied and loathed. And that one hasn't worked out quite so well. He had 5 or 6 positions for the roundtable in GE, and you talk about returning to the trend. I actually believe that GE is returning to a trend. It's just a different trend. The new management and all that stuff probably is okay, but
well, I've confessed, Mark, I've confessed a number of times at this show and that Ticker Talk that I own shares of GE that came from my dad. And my wife pointed out to me less than a week ago that for the first time in maybe 10 or 12 years, GE is now making money. It's about a 38 or 39 year holding, and it's finally making some money for us. So I think it was like $60, something like that. But that's quite a return over that period of time,
Yeah, compared to what it has done. And Kim, we'll take a look at LCI Industries in a minute, but that seems to be a position we sold in the midst of buying it, and I don't remember doing it that way. I'm not going to talk much more about Zoe's Kitchen. We talked about it during last month's bull session because I also featured it in July 2017. And even though this particular position lost slightly, we actually got into this at a original cost basis closer to $6 or $8. So the net of the two positions actually worked out pretty well, but Zoe's Kitchen was taken private about a year after we selected it 4 years ago. So here's a look at those 3 companies, and then we'll switch to Ken's FleetCor. Just a moment of tribute there for GE. We have talked about the reverse split and the change in the company and the change in the culture and all of the above. It's a complete train wreck from what it was 10 years ago, 5 years ago, and it has transformed into a company that I think probably has some potential, but it's clearly in show me state now, from my perspective. All right, so here's the look at LCI Industries. It is still one of the favorites at the roundtable. There's actually 4 active positions, and what happened with Kim's position is it was selected back here again 4 years ago and got kind of dinged during that economic hiccup that came around the beginning of 2019, end of 2018, and we actually exited her position as shown here with this red arrow. But at the same time, we had bought some, so kind of a little bit confusing as to what's going on there. But we actually recently reaccumulated. I believe, Ken, did you bring it to the roundtable last month?
I don't remember, Mark, but LCI along with Gentex were the other 2 stocks on my very short list, plus the third one I'm going to present at roundtable tonight. But LCI and Gentex came down to the very end in my screening and my thought process this month. So I like this stock an awful lot.
Any update on your perspective, Kim?
It kind of fell off my radar, truthfully.
Okay, one of the things that I think is kind of interesting is, we did accumulate some shares there in 2018, and it's turned out over the long run to be pretty formidable. Notice that the onset of the pandemic economic moment there, it was pretty abrupt, pretty deep, but it's in an industry that continues to thrive fairly well, and it's fairly well managed, very high quality rating, and it's in a bit of a flat spot for the last year or so. So I suspect that's one of the reasons it ended up on the roundtable a month ago and seconded by the audience a month ago. So continue to have a fairly favorable outlook.
they've improved, Mark, almost 10% their percentage of LCI materials within an average RV. That's one of the measurements that the company uses to show growth, and they're up to about 34% of the components in a typical RV can be attributed to LCII. So when RVs are selling real well, LCII is doing quite well.
It'll be interesting to see what happens with them whenever interest rates do come up and people, if they don't have a fixed rate on the new RV that they bought, will people want to start selling their RVs, and will this affect LCII?
Absolutely. So it'll be kind of interesting to watch to see what happens in that sector and industry, and we'll keep rolling. All right, Ken, here's your chance to expound a little bit on what you thought 4 years ago and what has actually unfolded.
Well, the business model has changed quite a bit for this company, Mark. They've always been dealing with fleets for companies, for government, and they've been providing credit as well as tracking software so that you can use the FleetCor card to charge a lot of the associated costs with, if you're a part of one of these fleets that's a member of FleetCor, and then they can break it down for you for your business or for the government as to how much was lodging, how much was food, how much was fuel, and all those types of added extra attractions. But FleetCor is moving into some fintech, and I would urge, if you're interested at all in this company, it has a pretty nice looking visual analysis, pretty nice looking graph set. If you're interested in it, go to the website and look at their presentation that they've made. The most recent one is just for general investors, and you'll see that they're beginning to reinvent themselves and to get a piece of this fintech fame and fortune that's out there for companies that are finding ways to digitize things that are in the financial field. So it's a really interesting company. The growth has been strong. As I said before, the last 18 months have been challenging for them, but it wasn't one of these fall off the cliff kind of events where where sales just plummeted and earnings plummeted. They did slow down quite a bit though, as truck fleets and government fleets were sidelined for a period of time, but they've come back. And as I indicated, the club in Bridgeport, Michigan, the first model club that Mid-Michigan put together, is really considering a purchase for it. We don't happen to believe the dots that you're showing and that you've circled up there, Mark. We've listened to the reasons for why that's going to happen, and we can't visualize that happening in that manner. So it's an active disagreement between the folks that are watching FleetCor for us and some of the analysts that are predicting that FleetCor sales will be flat to down a little bit going forward.
Okay, just to clarify though, Ken, this is actually the chart from 4 years ago.
Oh, okay.
Those are actual numbers. So yeah, they saw some pandemic impact, but not bad. And what you're referring to is that red line has actually continued to, the numbers are now up here. Yeah, so
okay,
we're not in disagreement.
We saw it staying on trend is what I guess what I'm saying. Yeah.
Yeah, they're restored to trend, if not better. And when your trend looks like this on the profitability side, you have to be pretty happy. All right, so if you want a little bit more on what, because I featured it at Manifest Investing, if you want to go back in and dig in the forum for that, a review of FleetCor from 4 years ago, And again, it has been featured a number of times at the roundtable, so you can do that also. All right, good stuff. All right,
I'm getting a comment, Mark, from Matt out in the audience that just is drawing our attention to Camping World. He says that the RV industry is doing well enough that Camping World has doubled its dividend to $2 a share. That brings it up to about a 5% yield, and that's a significant yield in today's market. I have a son-in-law working for General RV, which is also a chain that handles the sales and servicing of recreational vehicles. What I found so interesting when he sat at the last family dinner was that they usually park these things as close as they can get them on a huge parking lot at the outlet where he happens to work. And they're now parking them 5 and 6 parking spaces apart because they can't keep some of the models on the lot, and some of the models are being slowed down in the whole process with the supply chain, especially, just like automobiles, especially chips that are being used more and more in a lot of the applications within the mobile home. So just the demand is there. It's just, can they meet the demand going forward?
Well, I also wonder if people's behavior has changed because of the pandemic and they want to be outside more and they want to do activities. I guess the question will be going forward is, will people continue with the change of behavior that they want to do the RV outdoor activity thing, or will they do something else? I think we've had a change in behavior. The question will be whether or not, for me anyways, will that behavior continue on? And also, people may not be impacted now because of interest rates, but will they be impacted in the future?
I'm wondering a lot, Kim, whether empty nesters that are looking to downsize in homes are being shocked by the stickers on new home prices or even on existing home prices. And maybe that's helping support the market also with some folks in the baby boom generation who are deciding that maybe living for a year or two on the road isn't all that bad a thing. Let's give it a try.
There's that, and I also wonder where you have hot housing markets. Like right now in Fort Lauderdale, it's a hot housing market, but I'm starting to see prices fall because they don't stay sky high forever. It's going to be interesting to see how it all plays out.
Very fluid situation. Yeah, there's a whole bunch going on with people concerned about the long-term condition of the housing industry, for sure. All right, let's go ahead and press on. Unless you got anything else you want to add to that?
Nope.
No.
Okay. Thought we might spend a little bit of time with Mark Holbert and this. And I actually started off with an article by Mr. Holbert on Market Watcher in the Wall Street Journal that had to do with 8 market indicators, and actually ended up focusing more on one and coming back to one of our old favorites here. But just wanted to spend a moment talking about this situation because there's a whole bunch of people. In fact, the theme of that article was all 8 of those market indicators were basically flashing run for the hills. We've talked a little bit in recent months about the Buffett indicator, which is, flashing some type of a warning signal. I'm not sure how much value those things really have. They kind of elevate fear. I mean, look at this article here. Certainly preying on some fear components pretty clearly, but just thought we might spend a little bit of time talking about this, and I think it's taking us down a path that Ken and I are going to do a little bit of expansion on this theme in the not too distant future. So here's a look at it. Mark Hulbert in a Wall Street Journal article actually went back and dissected a little bit of this kind of stuff, but this is actually from the original blog post at Philosophical Econ. You can still find this online, but what you're looking at is a chart going back to 1952. I like that because it's post 1940, so that'll get my attention a little bit better. And what you're looking at is a comparison of the average amount that the average household has invested in stocks is actually the red line over time, expressed in a percentage, which is shown on the left y-axis. So you can see that it's kind of fluctuated around, and the 80s were tough after the inflationary 1970s. We could spend a complete session on how that was actually a wonderful time to buy individual stocks. And you could make a whole lot of money if you could grit your teeth and find excellent companies at good prices. And in fact, the track record of Better Investing Magazine during that flat spot in the middle of that chart was exceptional. On the right-hand side, the y-axis is actually taking a look at the subsequent 10-year total return percentage for the S&P 500. So it's a return on at least one measure of general stock market performance. And the moral of the story is that when interest in stocks gets overheated to the point that everybody's talking about them at the barbershop, at the neighborhood barbecue, and just more and more people are opening their Robinhood accounts. Obviously, it wasn't Robinhood back in the year 2000, but you can actually have periods of weaker performance over time. So the fact that these two lay on top of each other makes it one of the more compelling indicators to at least scratch your head over out there. Your thoughts, Ken?
Well, I like the fact that they tend to. It looks like it's tracking. I'm not quite certain that the time period is long enough for us to come to some conclusions about. I would like to have a little bit more information on where they come up with the average investor equity allocation. What's the basis for coming up with that figure right there? I'd like to understand that a little bit more before I'm willing to buy in, but it certainly is evidence, at least one piece, that there might be something to this whole concept. Do you have any idea, Mark, exactly the mechanics for calculating this average investor equity allocation, this percentage?
I don't, but this data is from the St. Louis Federal Reserve, so you can actually go to Fred and dig into it. We could do that for a future session if we see enough merit in doing that. But I mean, it's government statistics, no different than the gross domestic product, the GDP, and that kind of stuff. So again, it's just a matter of how do they do the calculation.
Would this include money in stock funds sitting in IRAs and 401ks and 403bs, do you think?
At a glance, that was my interpretation, that it did. That it would include the exposure both directly, because it actually calls out direct and indirect ownership of equities. And the indirect, they're talking about, trusts and funds, institutional ownership.
Okay.
So, it's got a chance of being fairly representative of, the mode of investing in stocks. In volume, if that's the way you want.
Right now, this goes through 2013. Have we gotten a way to extend this to through 21 to see what it looks like?
Yeah, and I'll do that. But first, I want to just point out that this is true for us, and we don't invest in these. And sometimes I get a little bit skittish about caring too much about market levels and this kind of stuff. I mean, We invest in companies. We find excellent companies. We buy them when they're on sale, and really don't care too much about what's going on in the general market when it comes to this kind of stuff, with very few exceptions. I mean, there's legitimate exceptions to where you do have to care about those macro or global indicators, but my personal perspective is there's more of a fear component than it's worth. So that's just Mark's soapbox moment. To answer your question, Ken, yes, here's the situation with more current data extending beyond the year 2013. And there you get a little bit more of a hint there with the directly and indirectly held up at the top as a percent of financial assets. And you can see that we are at least a multi-decade high level. So that is just a look at the amount of equity investment, again, personified by, in many cases, millennials and some of the younger baby boomers that seem to be getting more involved in the stock market here over the last few years. I just love the fact. Go ahead, Ken.
I want to explore just a little bit more, Mark. Wouldn't we have naturally pushed up stock ownership as companies did away with traditional retirement plans?
That's only if the employer mandated that each employee participate, because not every employer mandates that they participate in it, and every year that they have to increase their savings. Some employees have mandated that, some have not. I think the biggest thing is because of the pandemic, more people have learned, well, and I think this will ultimately change again. People learned how to, to save. And now, because everything has been so cheap for so long, there may be many who are going to have an eye-opening experience when interest rates start rising and they don't know how to pay all the bills because they thought the interest rates would stay so low.
Yeah, it's a tough question, Ken. I'm with you in terms of you also have to look at what's happening with that other slice of personal investing. In many cases, that can be the residence, the equity in your residence, and I'm not sure how much of that is in here. So real estate investing, if you will, real estate that you live in is a part of it. But I think it would be interesting to take a look at how they are forming that number. But you're right. I mean, the amount of direct interest has certainly gone up here in the last couple of years. Yeah, but the point to be made is no matter how they're measuring it, it is at an all-time high now. And lining up with the work of Mark Hulbert and the blog writer and a few other people, they're basically just saying that the 10-year market return is rightfully expected to be fairly subdued. In this case, somewhere around that number. And that's not dramatically different than what we see with MyPar and the value line median appreciation projection. I don't think it's anything to panic over. And maybe that's the difference between the way we look at the planet, in this vein, but certainly consistent. And then you can look at the work of Jeremy Grantham, where I think he believes that number is closer to -5, not +5.
Well, I'm only going to ask one more question, then we can move on, Mark. Where would an organization like CalPERS be classified? I noticed that the line up at the top there says households and nonprofit organizations. Is CalPERS a nonprofit organization? Is the Michigan Public School Retirement Fund a nonprofit corporation? I'm wondering. I don't think they pay taxes. I mean, that's where hundreds of millions of dollars are sitting in some of these retirement funds, and most of that is devoted to some type of investing, a lot of it to stock investing.
Mm-hmm.
So as I say, I want to know how this number is being generated before I say to myself, this is something that I should take a look at. Is it coincidence that it's matching the graph right now, or is it something that we really should take for gospel?
Yeah, and again, we can dig in a little bit deeper. In fact, Ron Thorson's not on the call today, but he has plenty of experience with the Minneapolis Fed. Perhaps we can get some commentary from Ron. But yeah, it does this accurately reflect the amount that people are investing in individual common stocks as a percentage of their portfolios over time? It's a legitimate question. I do not know, other than to say that, that lots of people are presenting it now, and it really does have a fairly strong correlation, as shown in that slide a couple slides ago. So it's interesting.
Yeah, Kay, I can explain your one question. Kay wanted to know why the blue line doesn't go past 2003. That's because it's looking at 10 years of, you need to go back a graph, Mark, to answer Kay's question. That's because it's looking at 10 years of data to come up with the match, and from 2003 plus to 2013 is less than 10 years. So you're going to have a lagging blue line by 10 years. As that red line moves to 2021, that blue line will move to 2011. So that's just the way the graph is constructed.
Yeah, and if we updated this particular chart that's on the screen right now to include the data from this chart, what you would see is that the market performance, again, thanks to the problems we had 10 years ago, is going to compare pretty favorably with this. In other words, the red line, if we extend it onto this graphic, is basically going to lay down and match up through this entire period pretty well. So, take it for what it's worth, I guess.
Well, count how many more years you got to live too, and see where it's going to go.
So we may dig into this a little bit deeper. Ken and I were talking a little bit before the session about how, and I don't want to go too deep into it right now. We can certainly think about whether we want to tackle it for a future topic, but this notion of when do you go into cash and how much, and I just kind of bridle at this notion of fear driving things, and when can it be right? There are some times when it is right to go into cash and preserve capital, but I can tell you more horror stories about people, especially some younger people, who have basically gone into cash even here in the last 18 to 24 months, and they're having a heck of a time, redeploying that cash into investments. I mean, they basically went into a full protective mode a year and a half to 2 years ago, and they're having trouble getting back in, and it hurts. It just hurts, because I know how much damage can be done. And the topic that I want to encourage us to give some thought to is, especially for investment clubs and for the vast majority of investors out there, there are exceptions that are worthy exceptions, but boy, so much more good can be done by pursuing what I refer to as quality allocation, instead of playing around with the asset allocation of shifting from equities to cash and trying to time the market. And I know it's a controversial subject, and I'd probably be stoned by accountants and financial planners, but I just have so many examples, including what happened back in 2008, 2009, where it just made sense to buy excellent companies at a good price, rinse and repeat, through all the madness. So, Ken, is that some area that we could perhaps kick around?
I not only can we, but we should, Mark, because I belong to a club that kind of stumbled in this last real big downturn, and they were quick to sell companies that maybe weren't going to perform for the next year, 2 years that they owned, but were very slow to redeploy that money into something else. And so we're caught with large amounts of cash when that market turned around and went the other way. This was not a downturn where you had the luxury, as in 2008 and 9, where you had a couple months luxury to think about things and to redeploy your cash. If you didn't redeploy cash in a lot of instances within a month or 6 weeks, then you had already missed the bottom, but you still could have found better ways, I think, of letting your cash sit. We talk specifically, Mark, about looking for high quality companies and parking cash in high quality companies, even if they're not particularly in the buy zone for the moment. And I know that rankles folks that are very dependent on using the stock selection guide, but there was no good place to park money this time with interest rates at zero or close to zero, or in cases below zero effective interest rates. So maybe we need some words of wisdom for the next downturn.
Yeah, again, I think it's so important that you have to do it before the downturn. And and in this case, I think we're probably pretty close to being there. And there is ratchet up quality, overall quality in portfolios. And I'm not so sure that we aren't there. I'm not, my personal attitude is don't necessarily go to cash, but go to quality. And you can find a Costco and a few companies like Ken just mentioned, and maybe that's where we need to spend some time. I think we're probably there, and especially if you're a person with a shorter time horizon, certainly there. So,
well, I'm even thinking, Mark, that a sort by quality and then moving 4 or 5 from the bottom of the quality list and redeploying them into companies you already own that are at the top of the quality list. I mean, we have shown graph after graph after graph that indicates that high quality stocks don't move down nearly as far as the market moves down, and they tend to recover more quickly when the market recovers. We're not saying that you won't lose money in a sharp downturn, but I'm not sure that holding cash and becoming paralyzed about trying to get back in accomplishes anything except giving you a nice pile of cash when everybody else is adding 30, 40, 50% to their pile.
all right. Well, you've inspired me to find the highest quality exchange traded funds and mutual funds for this month's newsletter. So we'll leave it at that for now, and certainly come back to the topic. Again, the topic being the difference between quality allocation and traditional asset allocation, which involves generating a pile of cash. We'll just leave this topic with one last graphic. I know it's a little bit busy, but many of you have seen this before and you just need an update on it. This has actually been published in the Wall Street Journal by Mark Hubbard a few times over. I tend to think of Value Line as being a pretty close, certainly looking at the stock market from a very similar perspective of both manifest investing and better investing. I think they're 3 peas in a pod. And what you're looking at here is just an attempt to discover if the return forecasts that are in the Value Line Standard Edition over time, how do those do over 4-year periods? So from left to right, again, a little bit of a confusing chart. This goes back to Kay's question. The time between the red bars, which is the forecast dates from 4 years ago, versus the green, which is the current actuals. And that's what you're looking at here. That's why there's a missing 4-year period. The most recent actual was actually June 2021. We're coming up on the end of September. And you can see that the return between June 2017 and 2021 was about 15% versus a forecast from 4 years ago during June 2017 of approximately 8%. So that's what you're comparing on all these quarterly points, snapshots of time going back all the way to 1999. And my feeling, my instinct on this has always been that, with a couple exceptions, this being one of them, got a little bit weird here, those green lines track pretty well. And what this basically says is our stock selection guides, our stock studies, who behave in very similar fashions, they work. There are always going to be exceptions to any tool, anything like this, but in general, the green line does tend to follow those red lines pretty good. And so we're looking out here to the right-hand side, seeing numbers which are near historical lows. Again, I would say that's an invitation to ratchet up quality a little bit. But I do think that they do compare pretty favorably. I do blame this white space here on the pandemic and what may historically prove to be kind of an artificial moment economically when we look back on it 10 years from now. So it's a busy slide. Just kind of think about it, scratch your head. The story that you should take away is that stock studies where you actually sit down and imagine what the company might look like with a long-term perspective actually work in general. Not for every stock, not all the time, but taken as a homogeneous mixture, it seems to behave pretty well for me. Your thoughts, Ken?
I can do nothing except agree, Mark.
And I can add here, guys, I've been burnt plenty of times in the market, and one of the things that I have learned for myself is that when I find a company that has, as Mark and Ken, you both say, great quality, most times you have great management who've got great capital allocation skills, and that capital allocation skill can be seen what their return on invested capital is, of how they've invested their cash and deployed it in the company and what kind of returns they have gotten. So I'm getting pretty picky that I want to have a cash return on invested capital of at least 10 to 12% minimum. Being real picky so that I'm making sure I'm getting quality as number one.
Absolutely. It just stacks up and makes all the sense in the world. So,
well, Mark, if you can go into a stock with an upside downside of 2 to 1, and compare that to the upside downside of cash, which is, well, I don't know, what is the upside downside to cash when it stays consistent, stays constant? There is no upside downside to it. Maybe if the quality is high enough, 2 to 1 upside downside in riotous times is what we should be looking for occasionally.
Yeah, it makes all the sense in the world. I mean, there is no inflationary compensation in cash when it comes to upside downside. So maybe that's the way to think of it. All right, I propose we spend our last 5 or 10 minutes kicking around this notion. Trust, but verify. I suspect that, Ken, you're very much in favor of this.
Absolutely.
Okay. All right, here's some of the screening results, which I used to try to form my shopping list for tonight's roundtable. The one at the top is simply companies which may be dramatically, or temporarily oversold. And from Calvo Growers down to Boston Beer, chances are 99% that I'm going to present Boston Beer tonight. Just on the strength of their overall picture, their higher quality. Morningstar thinks they're on sale, as you can see here. But these companies are all pretty much compelling with respect to being potentially oversold. And I just note the presence of the word food because, again, Maslow was right. Food is one of the things we need. So the next set of results is just top quality and highest projected return on value. And that's also a pretty decent shopping list. This is a Chinese company, so you have to decide whether you're ready to venture into that minefield yet. And so I'll just kind of leave it at that. But the one that really triggered was right here, our ivory screen, where we're basically listing our highest projected annual return. That's the return forecast for the companies we follow. in combination with their quality rating. And again, we see some companies that I believe that you're going to hear about this one tonight. LCI comes back for another appearance. Here's Gentex, which has been mentioned. Just a bunch of companies which are kind of on the tip of our tongue. And as we've been talking, I think quality probably matters as much or more than ever. And what kind of triggered this was the drooling which commenced when Ken and I both saw NVIDIA on this list, because we both were drawn to it. It's a formidable company. Chips are hot. In fact, there's a couple other chip companies here which have been part of discussions at over the last couple of months. But NVIDIA just seemed like, wow, pretty good opportunity, huh, Ken?
Well, that's what I thought when I did my first screen a couple days ago, Mark. Yeah.
And that's where the trust but verify comes in, because I'm pretty sure that I corrected this at least once and probably overwrote it in the database. But the problem with the NVIDIA situation is they now have 2.5 billion shares, not 637 million. And that basically messes up some numbers. So
Did you say 2.5 million?
2.5
billion.
Billion, okay.
So they had a 4-for-1 stock split, which has been kind of awkward. I hate stock splits, but don't get me started on that. We don't have time. So a quick audit of the situation does reveal that there has been a 4-for-1 stock split. So all the numbers that are affected per share have to be fixed. And what you basically end up with at the end of the day is a projected annual return that is basically relatively close to zero. How close it is to zero is a subject of great debate, but it's not 20, it's not 10, it's something probably single digits. And the projected return on value confirms that, amongst the lower numbers. Obviously, Value Line does not think it's a screaming buy with those type of numbers, but that is the situation. One of the numbers which has disturbed us a little bit here lately is we do use the Value Line 3 to 5 year forecast for companies, and sometimes that can distort the analysis of companies also. So we will pay a little bit closer attention to that. The result in this is it's not what it appears to be in those screening results. So again, screening results, they're a starting point, not an end point. And we do try to catch these, but every once in a while, one of these does wriggle by us and results in a phone call from people like Ken. But the story is a little bit even deeper, and this is something Ken and I talked about for a few minutes. This one really has the analysts confused, and that can often be quite an interesting opportunity from my experience. I think back to Qualcomm in the late 1990s. I don't think this is quite that same order of magnitude, but I want you to notice that the stock price is above 200. Morningstar doesn't think it's dramatically on sale. They think that the fair value is closer to $138. In fact, they wouldn't be interested in buying it until it was down in the 69 range. That, to me, strikes me as a little bit conservative. Notice what the rhinos think. Dramatically different opinion versus Value Line. These are like two different universes. Two movies, or the same movie on two different screens. I don't know, whatever you want to call it. They clearly don't agree with each other. And the analysts who follow the company are quite optimistic about it. Notice where their buy, hold, and sell recommendations stack out. And they actually have a target price which is pretty close to the current price. So there's just a whole bunch of confusion. So again, the message is there's an awful lot of ways to look at companies in the market. It's what it takes to make a market. But some pretty solid confusion out there and differing opinions. Anything you'd like to add to that, Ken?
Only that NVIDIA is one of the few chip makers, I think, that is not making a commodity right now. I think many of the chip makers have been reduced to just making something that's a commodity, and you buy the cheapest you can because within a certain class, they're all basically the same. NVIDIA has distanced itself from that problem for the moment, at least. How long will that last? I don't know.
Yeah, and the explosive change in stock price from single digits here to where it's at now in the 200s. I mean, it has had one heck of a run. Don't get me wrong, great company, and as Ken said, not a commodity, but certainly a wide variety of opinions, and in some cases just data that needs to catch up. So trust but verify. All right, here's your monthly reminder, or your weekly reminder in this case. We do put these sessions on YouTube at the Manifest Investing channel, including the bull sessions, the expected returns summaries and reviews, the COVID cancellation, successful investing conferences that you can see in the middle of your screen, and all the round tables. Here's an example of the round table from May here. This 5-session conference is all here if you want to dig into one of these topics a little bit deeper. And with respect to the successful investing stock panel, although we're not doing quite as well as we have in the past, here's an interesting fun fact for you. And we'll just leave that with a smile. The average rate of return for the 3 stock panels is currently 27.9%, which that's just good, clean fun anyway you shake it.
Everybody should be grinning with that.
Yep. And that's with a couple considerable challenges, including my emergent biosystems, which doesn't seem to want to behave. All right, and we'll just leave with one landscape. I think that's a nice picture. Anybody want to hazard a guess as to where that's from? And Ken, you're disqualified because you've probably seen the hint slide. Just enter it in the top in the comments if you want to take a guess. Where does that look like it might be from? And here's your hint. One of the most famous photographs in the history of National Geographic magazine. That happens to be what they entitled at the time Afghan Girl. So not all of Afghanistan looks like what we see on the news all the time. And again, thoughts and prayers for Louisiana, thoughts and prayers for that entire situation over there and our leaders and the people that are affected. So with that, I think we can go ahead and wrap up for tonight. Any closing thoughts, Ken?
Nope, I'll see you again tonight, Mark. Boy, you held right to 3 o'clock today. That's great.
Yeah, consider we were shooting for shorter than 3 o'clock.
Right.
Well, thanks everybody for attending. Again, thanks, Kim. Stay safe down there. Hopefully we'll see you tonight. And
Fingers crossed.
okay, everybody have fun. Get out there and shop for quality companies. When you find a can't miss high quality opportunity that we should all be aware of, please make us aware of it. Thanks, everybody. See you again.
Bye-bye.
Bye-bye.